let me get going here. A supercharged 6% protocol variant. And so what that is, we've got a 6% protocol running over at Trading Trainer, and it's a program that I started back in 2007. And we had a lot of people join up in 2007 to the point where in 2009 I had to close it down because I had just too many people working with me. And those people have all graduated. Those people have all been doing fantastic with their portfolios after so many years. And so I opened it up just recently back in February for a new group. I like working the long game, not the short game. So it's more of a marathon for me than a sprint. With that said, before I get going, and I don't have many PowerPoint slides, we're actually going to do some training up here. We're going to pull up some tools and do some analyzing. I do want to make sure that everybody who's on the line can interact with me. So I actually have the ability here. It looks like I have the ability to see everybody laid out on my little platform here with as if you were in school. And if you notice up on your webinar control panel below the orange button with the white arrow on it, you'll see a little button that's like a hand. And that's your hand raising button. And that's the button that you're able to kind of interact with me. So if you don't mind, test that button right now. Click on that button. Your hand will go up. You'll notice that the button changes shape or gives you a different sign, meaning your hand is up. Sometimes I have people attending webinars with me and they keep their hand up the whole time. And then when I ask the question, they put their hand down. So you want to get an idea of when your hand's up versus when your hand's down, because otherwise you just look silly and your arm gets tired, even though in the virtual world, your arm won't really get tired. But I like to make these a little bit interactive so I can know who's going up. So one more time, if everybody could raise their hand, just let me see that you know what you're doing here. Fantastic. Fantastic. I actually have a button here that I could put all your hands down for you. The other thing I recommend, just to make sure that, especially when I get into the graphs and tables, that you're not getting your view blocked by that webinar software, you might want to press that orange button with a white arrow on it, because that's going to go ahead and minimize the bulk of the software off your screen, leaving behind just that little grab tab. And that's really all you're going to need for at least my presentation. All right. How many with the show of hands are ready to go? Cool. 6% protocol variant. So today we're talking about put protected call writing on leaps. But I did promise that first of all, how many with the show of hands have ever actually even heard of me before? Fantastic. Awesome. And just because I like to see the other side of the coin, how many with the show of hands you never heard of me before? AJBrown Trading Trainer is the name of my company. Been around since 2003. Oh, well, been teaching equity options at a company that I started called Trading Trainer. That's TradingTrainer. And been doing that since 2003. And start these programs, and I'm in it for the long haul, so I work with people for some people I've been working for as much as a decade here. Not really interested in the volume of students, because the whole thing started, and I'll just give you 1 minute with me. The whole thing started with me working with some inner city kids in Denver, trying to get them off the street by showing them how to do things with money. And also, if you know anything about inner city kids and how to get them off the street, you got to give them something that gives them an adrenaline rush. And what better to do that than with trading, right? Or with some sort of investing, because that could give you just as much adrenaline rush. You got to get them to stop gang banging and start banging on Wall Street. So that's what I did, and then decided to take it to the public and play the Robin Hood games. In other words, take some of the money I get from educating, not some of it, but all of it. So I do all my own trading, and then I take all the money from the education business of Trading Trainer and give it to the kids. All right, so that's enough about me. Hey, same thing like Jeanette. One thing I'd like to do, I'm going to quickly come over here and visit the 6% protocol site in front of you guys. And that's just because I do want to echo what she said. Down at the bottom of 6percentprotocol.com, you'll find also where you can read about investment risk warning and financial information. Just make sure you know what you're doing. Make sure you have guidance. Make sure you do your math and your money management ahead of time. And one of my things that I've learned over the years is, and I started trading options in 1997, started trading stocks in 1994. One of the things that I've always learned, if it smells that it might not work, it probably isn't going to work, right? There's no magic out there unless you actually look at where most people don't like to look. There's no silver shining, there's no special lantern you can rub, although people will pay tons of money for it. The magic comes in your money management and things like that. Okay? Cool. All right. So I'm going to cover 5 bullet points. I've got about 45 more minutes from where I am. One of the things that I do, because I've got this lifestyle, my main company, just so you know, is in Fort Collins, Colorado. I like to live. I have a home in Fort Collins, Colorado, but I also have one where I am right now in Washington, D.C. I also have a home down in Myrtle Beach, South Carolina. I have a home in Cagliari, Italy. I like to spend a lot of time, actually not in Italy proper, but it's in Sardinia, which is an island halfway between Italy and Spain. And it's part of Italy, but it's really their own people, if you know anything about Italy history. So I like to be anywhere I want to be. And one of the things that I do here in Washington, D.C. that just gets me really excited is I've just recently, about 2 years ago, taken up doing the flying trapeze. So I'm out of here no matter what, because I got a flying trapeze lesson with a Circus du Soleil person at 10 o'clock, because that's what I'm treating myself for my birthday. So here we go. The one question I have for you, really, and a lot of people, if you're, this is going to tell me whether or not you know anything about investing, is if you had 50 grand right now or a penny that doubles every month, every day for a month, which would you take? How many with the show of hands would actually take the 50 grand? Choose wisely. How many with the show of hands would take that penny? Okay, let's check it out. So we got the penny, 2 pennies, 4 pennies, 8 pennies, 16 pennies, 32 pennies, nowhere near the 50 grand. In fact, we get all the way up here. We put a lot of work into this doubling of our penny, but day 10, we're only at $5.12. Anybody else around you would look at you silly if you spent all that time and at the end of 10 days, you only had $5.12, but they don't know about what you know about. So let's go up to, wow, we're already up to over $1,000 by day 18, but we are halfway through the month. In fact, halfway through the month at day 15. Let me get my little marker out here. Only got ourselves to $163. Gonna keep going here though. Now we're seeing at the end of the month, there's a lot of work up front in investing, takes a lot of time, and then all of a sudden, before you know it, it's compounding. Day 22, we hit $20,000. Guess what? Day 24, we're now greater than that initial offer I gave you of 50 grand. Keep going. And by the end, let me get rid of my highlighter there. You'd have $21,474,836.48 frickin' cents. Now, I don't know if Albert Einstein, there's a lot of suspect of whether he really said this or not, but, well, let's give it to him, because compound interest is the most powerful force in the universe. If you ask me, it's what affects your bottom line. You're probably saying, well, gosh, why are you talking about doubling a penny? Well, that's what that whole 6% protocol, that's the whole premise behind what we've been doing since 2007. if you focus on growing your portfolio by 6%, and many of you who have dabbled in options know that that's definitely a doable. Options have different variables. You can trade options optimized on directional movements. You can trade options optimized on volatility changes. You can trade options optimized on just time passing by. Now, how many with the show of hands? I gave you 3 options right there. Directional movements, changes in volatility, or time passing by. Which of those 3 sound like it's probably the most reliable thing to predict? Would it be the direction of an underlying symbol, ETF, index? They now have options on everything. Would it be changes in implied volatility, which is, of course, the buying and selling pressure behind an option? Or would it be just time passing by? How many with the show of hands would say the first, directional movements? Oh, well, the hands just went down. How many with the show of hands? A couple of hands went back up. How many with the show of hands say predicting implied volatility changes is the most reliable analysis method? Gosh, some of the people who are raising your hands, I sure would like to have you on my team. Finally, the most predictable analysis, who says time passing by? A lot of the hands are going up. Listen, a week is going to go by whether you like it or not. And last time I checked, they haven't changed it such that there's going to be any more than 60 seconds in a minute, 60 minutes in an hour, 24 hours in a day, 7 days a week. Time passes by at that consistent rate. So using the time decay or theta decay component of options, if we can optimize our option trading for that kind of component, it takes a lot of the time out of our way. I've been known as the lazy trader. I like to get as much profits as I can and spend as little of my time, my money, my resources doing that. I'm not one of those people who likes to throw around terms, trade the most obscure trading strategy just for the sake of it, go to cocktail parties just to talk about trading. Give me the tried and true things that work day in and day out, and then let me go play on the trapeze. Let me go scuba diving in my island home. Let me do all the things that a dream lifestyle is all about. How many of the show of hands agree with that kind of mentality? I did this trading stuff from when I started in 94 until 2005. At the same time, I had a day job. I worked at Hewlett Packard as a top-level executive in their computer services department, and living in Silicon Valley. And that's actually where I picked up a lot of the trading stuff with the weekend seminars during the 90s. That was before webinars, so you actually had to go to a hotel, and most of those were bogus. But the scoop is 6% protocol, 6% earned every month on your portfolio means, as long as you're not dipping in there, that you're going to be doubling your portfolio annually. So if you kind of take an example of $1,000 in 12 months, that would come out, if you compound it with the 6% protocol, at 2012, 4,048. And it does the same thing as our penny example. And in 10 years, you're a millionaire. Or if you do take money out, which a lot of people do, if you wind up growing your portfolio just to $100,000, you could be taking a paycheck of $101,219.65. That's more than like a top-level software programmer in Silicon Valley earns. And you might say, well, what's the whole big deal about that? Well, the whole big deal about that, of course, is software programmers in Silicon Valley basically give up their life and spend 70 hours a week coding in front of a computer. Whereas if you can grow your portfolio this way, as I've described, that's, very little time investment in a theta decay strategy, executed every month. All right, so enough trying to tell you about the 6% protocol. Let's actually get down to it. So I wanted to talk about what's the difference between covered call writing against different underlying symbols. So if I pull out my notepad here and start taking some notes, what are some different symbols we can write our calls against? Well, covered call writing by definition is writing it against a stock, then index, exchange traded fund. What we're going to be talking now is what about writing it against a leap? Now, it doesn't necessarily have to be a leap. We just like to use options that are far out in time. How many, with the show of hands, by the way, let me put your hands down first, are fairly familiar with options? How many, with the show of hands, options has never been something that you've actually delved into? All right, so it looks like about half and half. Here's the scoop behind equity options. Again, as I mentioned, they have profit, or they have profit potential in 3 different areas. They're called multi-dimensional. You might want to take notes, by the way. Multi-dimensional investment vehicles. So a stock goes up and down based on the buying pressure of that stock and the selling pressure of that stock. It's in a very emotional movement, right? When people want something, they start buying it, and when they buy it, the price goes up. When they don't want it anymore, they start selling it, and the price goes down. You don't just see it in stocks, indexes, and ETFs, but you see it in the everyday world. You see it on baseball cards. When there's a baseball card everybody wants, the price goes up. When there's a baseball card that nobody wants, it goes down. You see it in the price of gasoline. How many of the show of hands agree? And I appreciate those of you that are like, oh my God, he's talking about the basics. We're going to go really fast here, so please buckle your seatbelt. So stocks, whatever, the basic underlying symbols, they profit based on the buying and selling pressures, okay? We call them one-dimensional because that's really the only thing that influences the price. You might say, well, what about the fundamentals of the company? Well, that influences whether people want to buy it or sell it. But if you notice, you'll see a company like, for instance, just this past Thursday, where some information came out on a global scale about should we trust the president of the United States, blah, blah, blah. And so there was some sell-off. And, of course, the next day there was some buying back. So it was what I call a transient external stochastic shock. Put that in your pipe and smoke it. So, one of these news headlines goes by. Everybody decides they need to stick their money into the mattress. And no matter what the reason is, you look at like a company like IBM, they had about a 1 or 2% drop that day. And then you say to yourself, did IBM lose 1 or 2% of their workforce? Did IBM lose 1 to 2% of their products that they sell? No, it's about the buying and selling pressures. The more and more correlation between underlying symbols has more to do with a stock price, thanks to the proliferation of ETFs over the last 10 years, than the actual fundamentals of a company. Now, coming on back to our options, you add an expiration date on a derivative, right? Derivatives have expiration dates. We're talking about options and futures here. And you start to add some additional variables that change the profit. So options as well, profit and loss based on the buying and selling pressure. So if you have somebody who's got a particular option that everybody wants, the price will go up, and vice versa if nobody wants it. And options are traditionally used as hedges so that they can be, so you can use options to actually determine, just watch it, how much the buying and selling of options is taking place, and you'll know whether people are uncertain about the market, right? All right. The other thing that, of course, because options are derivatives, they're linked to the underlying symbol price, the underlying, and I'm a better trader than I am a speller, underlying symbol price also has an influence on the option price. And options, of course, because there's an expiration date, they're called wasting assets, they have a influence on their price based on time passing by. Now, what's cool about options and why I like to trade them is because depending on how you mix them together and which ones you choose, meaning do I choose the ones that have an expiration date way far out in time, or do I want to choose the ones that have the expiration date, this month? Depending on which options you choose, and also do I choose the ones that trigger at this strike price or the ones at this strike price? And there's another variable. Do I trigger the ones that profit when the market goes down? Those are put options, or when the market goes up. So because I have this flexibility in choosing my options, and then I also have the ability to mix and match them in combos, I can trade anything. Whereas a stock or a stock or a commodity or a forex trader, you could only trade when the sentiment is up or when the sentiment is down. And so timing becomes really important for you if that's your sort of trading. Meaning you have to be there at the right place and the right time to place your trade. Whereas options, I have much more flexibility. Instead of just going long or going short, 2 strategies, I have about 27 different strategies to choose from. I make money whether the market goes up, down, sideways, whether people are up in their risk or downing their risk, implied volatility changes, or whether time's just passing by. So one of the things I can do is tweak which of these variables will be the predominant mover in the underlying symbol and in my option. So if I want to tweak it so that the option I choose mirrors the movement of the underlying symbol, in other words, it's a true stock replacement, then I'm just looking over here at the Q&A. Somebody wrote, options aren't for me, forex of futures. I'm in the wrong webinar. Be open to me right now. Be open to, you can shit can this, you can put this into file 13 under your desk after you've heard it, but be open. Underlying symbol price, you can optimize this simply by going far out in time with your expiration, right? That's why we like to talk about leaps, because they're far out in time before they expire. And you start to go deep in the money, right? When you go deep in the money and you choose that type of option, you're going to wind up getting one-to-one movement with the underlying symbol, and these other variables that can influence price get negated to almost have no influence on the price of that leap. So it becomes a wonderful substitute for the stock. Now you might say, well, why are you looking for a substitute? Because leaps could be as little as a third to half the price. If you're familiar with the covered call writing, what are you doing? We call it an instant dividend. You know what? I'm going to make this nice and big and fat so you don't have to squint. There you go. An instant dividend. Whatever you buy, leap, index, ETF, stock, as soon as you sell a call against it, especially if you sell the most probable call against it, you basically just bought yourself a coupon for that stock. That stock is still worth, or whatever the underlying symbol is still worth whatever it's worth, but you just got a payback, right? Now, I am going to go ahead and make sure you understand some of the pieces of this puzzle. And you say, well, wait a second. What about selling that? What we're doing when we do a covered call is we're actually on the option that we're selling back in order to get our instant dividend, which also becomes what I call a profit buffer. We're actually optimizing that particular option based on its ability to lose its value over time. So in that case, we're going to be using a near-term at-the-money option versus a far out in time, deep in the money option. So you might say, well, man, you're using two call options to do this. Yeah, they couldn't be more different than apples and oranges. How many with the show of hands understand that? Am I getting my point across here? How many with the show of hands? Let me be a little bit more, make sure I'm covering all my bases so nobody's losing it. How many with the show of hands, you're scratching your head and you're like, I'm lost? Oh, good. Not many of you. That's fantastic. Cool. Only a slight majority. All right. So we always like to look at profit and loss diagrams when we're option traders because in order to make sense of all these strategies, you got to understand how they profit. So when you look at these little diagrams, up here means you're profiting. If the thing goes up here, it's profiting. If it goes down here, you ain't doing so well, you're losing, right? And over here, along this, we like to track the underlying symbol price, whatever it may be, okay? So when you're talking about a covered call generically, you're talking about having a profit and loss diagram, just like a stock. So if you had a stock, if I bought it at whatever price, if it goes up $1, my stock goes up $1. If the underlying symbol price of the stock goes down $1, I lose $1. How many with the show of hands understand that? So when you do the covered call, you sell that call against the stock. And so that actually gives you like a little, could be as much as a 10% discount on the stock. And so the stock might be worth $100, but now your cost basis is $90. Now, of course, nothing is for free. So at some point here, whatever the strike price is, you cap your profit. So when we're doing the trading, we like to think about this as being our secret profit triangle where we like to live. So here, what kind of stock or underlying symbol are we looking for if we want to live in that profit triangle is what we call it. You're looking for something. If this is the underlying symbol price, you might imagine it in some sort of chart. Let me go ahead at this point and log into the web portal that we use here at Trading Trainer where I've got the 6%. So if I were to bring up my charts here, and one of the charts that I'm, and the team for that matter, I've been trading since February, is MDRX. So I'm just going to pull that up because it's such a great example. And while that's loading here, just show you, we keep track using the spreadsheet here of our covered call writing candidates. And so you can kind of see some of the, you see how we've been staying in them 1 or 2 months, some of them even more. Look at this one. I've been MDRX. Here it is, all Scripps Healthcare. We even had MDRX drop on us, and this is why I like to use the put protection. This thing dropped on us from $11, and then you can see here, or $13. You can see here we wound up getting called out at $11. This dropped so greatly, we thought, oh my gosh, if you, just like with a stock, if it drops a covered call, you talk about having infinite loss or actually loss all the way to zero like you would with a stock. But truth be told, there's a bunch of different strategies. We like to protect ours with puts, which actually wind up creating a ending zone where it can't go farther than that down. And after finally getting called out after a couple of cycles here, starting in October, ending in January, we still walked away with 14.4%. Some of our candidates pull back 22.7%, 38.2%. This is strictly covered call writing. This is not the variant that I'm telling you. Imagine dropping your cost basis by half to 2/3. In other words, increasing your profit numbers by 2 to 3 on the graph. All right, so now that we've got my graphs up, So if you can imagine, we were looking at our profit and loss diagram, and so turn it on its side. We were talking about what if we had a strategy that capped here, or even better, we had this would be our break-even line, and then it kept profiting until we hit our profit triangle. There's our strike price, maybe at $12, $13. And so if we can have a stock or a index or an ETF or a stock replacement channeling sideways, which I don't know if you guys have noticed the market lately. How many of the show of hands have noticed the market lately, that it's doing a lot of sideways motion for the last couple of months? A lot of you have your hands up. How many of the show of hands have said, no, the market's downtrending? How many of the show of hands think the market's uptrending? Maybe if you're looking at weekly or monthly charts, you'd say the market is uptrending. But if you look at just the last couple of months, it's been going sideways. So with that said, we're looking for sideways channeling stocks. We could have stocks that go up. We could have stocks that go down, hit our profit buffer, hit our put. But the truth is the best strategy is we look ideally for stocks like this. Let me give you 10 ideas. Or 10, what else would we call it? How about 10 tests to see if you found an underlying symbol that goes horizontal? Number one, let's look at our Bollinger Bands and just use the out-of-the-box setting, 20-day, and look at that Bollinger Band width. We actually have a tool that is part of the 6% protocol that assigns a number based on the last 6 months of Bollinger Band width. And we like to assign it 0 to 10. 0 mean it would be squeezed down to nothing. 10 would be the widest that it's been over the last 6 months. And we want the Bollinger Band width to be somewhere between a 4 and a 7. So about halfway to the widest and to the smallest that you've seen. In other words, not too tight, meaning not consolidating. We want to be seeing channeling, and that helps us see it. So Bollinger Band width. Number 2, how about candlestick count? How many with the show of hands are taking notes? Absolutely. If you don't, please go scramble and get yourself a piece of paper, pencil, or open up a document on your computer, but don't block my screen. Candlesticks. Count. So look at the candlesticks on the Bollinger Band. I only want candlestick bodies. I don't care about the wicks. But how many have I gone past? Let's do this, by the way. Bollinger Band, 20-day. Throw my candles. How many candlesticks can you count back since you've been outside of the Bollinger Bands? Actually, here, we actually popped out of the Bollinger Bands not more than 5 days ago. But the bigger the number when you're finding these underlying candidates, the lower hanging the fruit is going to be. Candlestick count needs to be a big number. Number 3, I like to overlay some EMAs just to help me analyze it. Look at my exponential moving average for 5, 10, 20, and I'm sorry that, this is like a lesson that I would take maybe 5 different video series, put out, and I'm condensing it down into about 50 minutes. So I can, listen, if you have any sort of questions about anything, AJ@TradingTrainer.com. Send me an email. I'm very responsive. AJ@TradingTrainer. Make sure you spell it right. TradingTrainer.com. And should you want to check out 6% protocol, I'll just put it out there right now. 6%protocol.com. Or you could even put the number 6%protocol.com. They both go to the same place. Check it out. All right. 5, 10, 20-day EMAs. I don't want to see them converging. No converging. I want to see them flip-flopping past each other. Let's look at those really quick. I'm going to, just because my charting software is silly here, I'm going to use SMAs, but 5, 10, and 20. But I want to show you just the pattern, but use the EMA. So let's ditch the Bollinger Bands and let's go here. So you can see the 5 EMAs. I want to see exactly this. I want to see them crossing each other and kind of going like almost like you would imagine on a waveform, like an oscilloscope or something. I don't want to see them consolidating down into one. Okay. Number 4. These are all tests that you can do to see if you've got the lowest hanging fruit, because the lowest hanging fruit's the easiest one. Number 4, I just want to look at a naked chart. So if I ditch all my EMAs and I ditch all my drawings, maybe even ditch volume and look at just the pattern, do I see that this thing is sideways channeling? I should be able to see it very quickly. If I have to stare and look at it to try to make it out, now I'm trying to trick myself. I should be able to pick it out. How many with the show of hands, I'll put up candlesticks so it's a little easier to see, would say that at least for the last 3 or 4 months, this has been sideways channeling, just from a naked chart analysis. Absolutely. Number 6. Actually, I skipped 5. Support and resistance. Listen. Good old support and resistance. Take that naked chart. Can I find lines where I have, especially in the case of this strategy, tested support more than once? The more times I test it, the more people who get resolved in that being stronger. It gets thicker and thicker the more times it's tested. So I want to see clear support and resistance that's been tested. Number 6. I want to jump over to a point and figure chart. I'll go visit my friend over at thestockcharts.com because they have a nice free chart. You might have point and figure charts built into whatever software you use. How many with the show of hands use point and figure charts? Point and figure charts were introduced to me in 2004, and they changed my life. You can see things with point and figure charts that you would have never known or around there. Here's a point and figure chart. Now that's gosh darn too small. So I'm going to go to 1,000 and zoom it in for you. Point and figure charts, instead of moving based on, incrementing a bar every time there's a time period, it increments a bar when there's a reversal. So right there, you can see where the reversals occur, right? Because it doesn't move to the next bar. You can see a whole bunch of data in a short amount of time, and you can see exactly where the tops and bottoms are. So I like to use point and figure charts in order to identify, again, support and resistance, double check it. So point and figure. And if you haven't had a chance to jump into point and figure analysis, get a book on it, do whatever you can, delve into it, take a course on it. Point and figure analysis is right up there with candle analysis. I mean, it is like one of the fundamentals that changed my trading. Next, after point and figure, I like to also take, and stock charts made it very easy, but you can use, and again, I have nothing with stock charts besides being friends. I'm not getting any kickback from telling you about their free tool. But they have this price by volume where they actually will overlay the bar graph at each price of how much volume has been traded. So again, that's going to reinforce where support and resistance is. It's that important because if we can find a nice sideways mover, we have the ability to be in these things for a long time. I like to call it price by volume. Number 8, fractal patterns. So I like to look at different time frames. Daily, 6 month. Weekly, 2 year. monthly, 10-year. Has this candidate been going sideways in all of those time periods? Even I could go down to 30 minutes and look at about 5 days. Has it been going sideways when I look at it each time period? If it has, it's more lower hanging fruit. You'll notice that when you think about these tests I'm giving you, this one's making sure that you're not getting consolidation, because consolidation means breakouts. And when you have breakouts, that's the worst thing for any sort of time decay, theta decay type strategy. So we don't want to have consolidation. That's what this one's doing as well. This one's just making sure that you've been horizontally channeling. This is helping you identify whether you've got a nice horizontal pattern. Let's do one more. This one's going to be another consolidation buffer, and that is, it's a cool little equation. How many of you show hands are ready to do just a little bit of math? I know it's early in the morning. All right. Here's what we're going to do. We're going to take the channel width and we're going to divide it by the average channel price. It's called non-dimensionalizing our channel. Let's go back to our daily, 6-month daily chart. And I drew myself a line of support and a line of resistance somewhere around $12. If we bumped it up here, where do I want it? Let's use a line on close to really nail this down on closing prices. How about $12.65? That's my resistance. I like round numbers because, as you know, support and resistance is subjective, but it's where people want to put their limit orders. So you rarely hear people calling their broker and saying, make sure you sell at $12.63 and a half. Hey, penny. No, they'll take round numbers. So round numbers have significance. It looks like support is at $11.75. So what's our channel width? 1265 minus 1175, 90 cents. Channel width equals 90 cents. What about our average channel price? I'm going to have to pull out my calculator because it's too early in the morning to do that in my head. Take the 1265 plus the 1175, divide it by 2. That's how you do an average. Average channel price is $12.20. All right. So now you're going to take the ratio. So channel width divided by average channel price. 90 cents divided by 1220. And this is a percentage. So 7.3%. If it's below 5%, I don't touch it with a 10-foot pole. I prefer 10 to 20%. That means that the width of the channel is about 10 to 20% of how the average price of it. Somewhere between 10 and 5, I get the heebie-jeebies. Below 5, I won't touch it. So that's the channel width. Channel width over average channel price tells me whether or not I'm getting into some danger zone. Finally, number 10, easy one, dividends. Listen, if a company is giving dividends, investors aren't going to put as much pressure on them to have their price go up. They'll be happy with it going sideways because they're making dividends. Which reminds me of something you need to know. If we substitute the underlying symbol with one of these optimized options that mirror the stock price action just to get the lower cost prices, we're not going to get to take advantage of dividends. They don't pay dividends on options. So keep that in mind. And you'll also want to keep in mind when dividends roll around. And we go through all these outlier cases when we do our discussions at the 6% protocol. But when dividends roll around, make sure you've got that in your radar so that you can adjust your economics appropriately. So here's the 10 tests. You don't have to get these 10 tests. First of all, you probably realize they're not black and white. They all have a sense of gray to them. But what I do is I've gotten to the point, and most of the folks that work in the 6% protocol, you can evaluate these 10 tests in about 3 minutes. So you want to be able to just quickly evaluate these 10 tests and find the lowest hanging fruit. Some of them will be, clear. Some of them will be gray. And if you're looking at the other piece of the 6% protocol that we have is we have a screener. Now, you don't need this screener, but this screener saves a ton of time. What it does is it actually goes through all the candidates that are available out in the market, and it matches options, and it looks for, I have an algorithm that I put in there, and it basically screens and finds the highest probable candidates to do this strategy against. But still, you wind up with, depending on what day, options just expired. So you wind up with, every day, the screener giving you as many as 10 candidates. As we get closer to expiration, it won't give you, more than one candidate. But if you're going to be spending 3 or 5 minutes and you're a lazy trader like me on each one, that's way too much. So what you want to do is you want to be able to quickly narrow it down even further, and that's where your 10 tests come in. Okay? How many with the showing hands follow? It's a sifting and filtering process. It's about recognizing these patterns before actually going with the strategy. So the strategy. Far out in time, deep, I better put a comma in there, deep in the money option. So for instance, on MDRX, if I pull up my option chain from the CBOE, MDRX, let's go ahead and see how far out they go. These guys only go out to December 2017. They don't even offer leaps. But if I had leaps, write this down, I'd be choosing all the way out to the January 2019 leap, because I've been known to stay in these candidates selling premium against them on average 4 to 7 months. All right. I like to do the months. You could do weekly. I like the liquidity in the monthlies, but you could definitely do weekly. But I've been known to do 4 to 7 cycles. My best is being in a candidate for 14 cycles. So the last thing I want is my underlying symbol to get into that zone where it's no longer behaving like a stock replacement. So I want it to be expiring way out in time. Now, in this case, MDRX, we can go out as December 2017. We can do what we can do. We want to go deep in the money, so I'm going to make sure I select. These, again, are all free tools. If you've got tools built into your platforms, by all means, use your tool. I just like to demonstrate on free tools because you don't need to really invest in anything more than just free tools that are available on our interwebs. Check this out. So we can go deep in the money. Now, there might not be open interest. Let's go with the 10. Currently, MDRX is trading at $11.90. The 10's got $2.30, $2.45. That's a much bigger discount, but guess what? I might want to go even deeper. The deeper I go in the money, the more I'm going to get at what's called parity. I'd like to talk about that more, but I'm running out of time here. But basically, the intrinsic value of the call will become the predominant all the way to the point where there is no extrinsic value. So if you put in a nice limit order right in between the bid and the ask, somebody might be enticed in order to sell you a call at that price. We had some folks doing it on Kohl's yesterday. He did a Kohl's. He went all the way out to January 2019. And Kohl's itself is currently trading at, waiting for the CBOE to catch up with me here. Here, I'll just do it this way. There we go. Kohl's is currently trading at $37.44. He picked up his leap. He picked up the $25 leap for $12. And now he's going to be writing calls against that $12. The calls are going to pay as much as if he would have bought the stock at $37.44. This is called a debit spread. So you can do it in a cash account. You don't need to have margin account. Your broker is not going to come to you for a margin requirement. And unless you get called out, if you get called out, they're going to do the difference between what you get paid for your call. They'll pay the difference with the lead. If you have questions of how that would work out, you can always email me, or you can talk to your broker. Your broker will explain it. Talk to the trade desk. So we bought it for $12, and then we are going to go with our near term at the money call option for what we sell our premium to get our instant dividend, to get our profit buffer, and then just to drop on it. And then I want to tell you about the 6% protocol. The last piece of the puzzle is if we start to identify patterns, we always want to do adjustments in times of peace, not in war, but if we start to see any sort of risk that the market's going to go down, we use our put protection, and we have a whole chapter on that in the 6% protocol. And ideally, 1, 2, 3 months out, because as soon as the scare has passed, you want to be able to sell it back. And if you look at my portfolio, that's a lot of times what we did. So take, for instance, PHH Corp. Here we are. Take CYH Corp. We bought our put protection for 15 cents. We wound up selling it back for $2.80. And that's why, even though the market went down, at the end of the day, we wound up pulling out 17.6% returns on our CYH trade. All right. How many with the show of hands followed a good portion of that? How many with the show of hands, you're like, what? He talked at Mach 5 with his hair on fire. And I picked up only a little bit. Listen, please don't hesitate to give me an email if you want clarification. This strategy works day in, day out. AJ@tradingtrainer.com. I can tell you about all the intricacies about how you can make the money in this strategy, even if the market works against you. And even better, I would love for you to check us out. So I have set up the most special link, 6pp.today. Nowadays you don't have to type in the HTTPS part. Just type in 6pp.today/TT, or actually TThirsty. Actually, I can follow this. Let me follow this. And I'll show you what you get to. You'll get to a page where yours truly will start talking to you. Yeah, that's how handsome I am. And you got some people talking about their testimonials. You got me showing my portfolio. And you get an explanation about what this 6% protocol. Now, we've gone ahead and give a big discount for the TradeThirsty folks. And so we've actually wrapped it up here so that, first of all, get in with me for 6 months, have access to the screener, have access to me. I actually help people with their trading and help them, do their analysis and come up with their plans. We also do a once-a-month Q&A webinar where we go over what needs to be known for the month. And I have the guarantee. If you haven't made money after 6 months, not only will I give you your money back, but I'm also going to give you $497. I'll double your money back guarantee, and that's because I know this works. We also put a second discount. There's a bunch of you that might be interested in actually doing this and focusing on the 6% protocol. You saw what would happen if you doubled your money every year for 3 years only. So for a huge discount, it would be $14.97, and you'd be with me for 3 years, and we'd set you up for the rest of your life. So I do really, really suggest you check us out. Again, the web page, 6p. In fact, I'm going to put it into the chat. Oh, it's already there. It's in the chat box, so you can click on it yourself. Some of you are probably trying to click on my screen. It's not going to work. But it is going to work if you open up your webinar software. So you might have to click on the red arrow and have your webinar software reappear. The link's right there. The link's live. And the offer is good for today. Send me an email at AJ@TradingTrainer. Check me out. One more question. Who picked up something new this evening you didn't know before? Or it's not an evening. Oh, my gosh. This morning. Awesome. Even better. Who picked up something this evening, new or not, but now you better understand it, better know it, better can use it. Awesome. And how many of you at the show of hands just you enjoyed yourself for this first hour? Even though I keep saying it's evening. Can't keep my days and nights. Hey, 6bp.today/TTThirsty, I'm sorry. And that's all I got for you. I'm going to go trapeze for my birthday.
That's awesome. Happy birthday, everybody. Wish our friend AJ happy birthday, buddy. Go get on your trapeze and be safe and, put on all those things that keep you from, not having a happy birthday.